Welcome to the inventory and cost accounting cycle. Before we dive into formulas and journal entries, let's step back and look at the whole map. This first section orients you to the entire course, the 6 phases, the departments that do the work, and the documents that carry the cost from purchase all the way to cost of goods sold. Think of this as the table of contents you'll keep returning to. Here's what you'll be able to do by the end of this section. First, explain the 6 phases that move inventory from procurement through reporting. Second, identify the 27 stages that sit inside those phases at a high level. Third, define what each department actually owns in this cycle. Fourth, identify the key documents that appear in each phase. And finally, apply this framework as a map so that every later section has a clear place to hang on. We're orienting here, not yet teaching the deep mechanics. Here's the key thing to understand before anything else. For a product or manufacturing company, inventory is often the single largest asset on the balance sheet, and it is also the hardest one to cost accurately. This cycle follows the full inventory life cycle, from the moment you place a purchase order all the way to recognizing cost of goods sold. Along the way, it goes deep on cost accounting, how costs are accumulated, allocated, and measured, and how different costing systems produce different insights for management. Get this wrong and your profit number is wrong. That's why we treat the whole journey as one connected cycle. The whole cycle is organized into 6 phases spanning 27 stages. Most people assume costing is just one step at the end, but it runs through the entire flow. Version 2 of the handbook added 2 brand new phases: Phase B, Cost Accounting System Setup, and Phase D, Variance Analysis. The original phases A, C, E, and F were then expanded with cost accounting depth throughout. Each of these 6 phases becomes its own dedicated section later in this course, so the structure you see here is also your roadmap for what's coming. Let's walk the phases in order. Phase A is procurement and receipt. This is how inventory enters the business, and it happens one time per purchase order, from raising the requisition to receiving and valuing the goods. Phase B is cost accounting system setup and standards. This is the foundation work you do once at company formation, and then refresh annually before each new production year. It's where you choose your costing approach and build the standard costs that everything downstream measures against. In practice, Phase B is the quiet phase that makes every later number meaningful. Phase C is manufacturing operations and cost accumulation. This is the engine room, where materials, labor, and overhead pile up into work in process and then into finished goods. It repeats constantly, either per production order under job costing or per period under process costing. Phase D is variance analysis, and this is the control check. Each month you compare what production actually cost against your standards, explain the gaps, and dispose of the variances at period end. The surprising part for many learners is that the variance isn't just a number. It's a question pointing at a root cause worth investigating. Phase E is inventory control and valuation. This one runs continuously. You count inventory at least once a year, and at every reporting date you test value using lower of cost or net realizable value, or LCNRV. It's where the balance sheet number gets verified and, if needed, written down. Phase F is sales, cost of goods sold, and reporting. It's triggered by each sale, releasing inventory, recording cost of goods sold to match the revenue period, and rolling up into gross margin and the financial statement note. Together, these last 2 phases close the loop, turning everything you accumulated back into a reported result. A cycle is only as good as the people running it, so let's meet the departments. Procurement raises and approves requisitions and purchase orders and negotiates terms with suppliers. The warehouse receives and inspects goods, raises receipt notes, enforces first-in first-out rotation, or FIFO, and executes the physical counts. Customs and logistics manage import documentation, classify goods under the right codes, and pay the duties. Quality control inspects incoming and finished goods, and crucially classifies spoilage as normal or abnormal before signing off on completed production. Notice how each handoff is also a control point. On the costing side, production planning and engineering version control the bill of materials, the BOM, and design the labor standards. Cost accounting is the heart of this cycle. It develops standard costs, applies overhead rates, accumulates work in process, calculates cost of goods manufactured, or COGM, prepares all 9 variances, and runs the LCNRV assessment. Finance then posts the journal entries and reconciles the inventory subledger to the general ledger every month. Above them, management approves standards and write-offs, while internal and external audit observe counts and test the numbers. Keep this cast in mind, because segregation of duties depends on it. Here's a principle that quietly protects the whole cycle. Duties must be separated so no single person controls a transaction end to end. Purchasing, receiving, and accounts payable are kept apart. Within inventory, physical custody of goods is separated from record keeping, and both are separated from the authority to adjust or write off stock. And when you count, the count team must be different from the regular custodian of the items being counted. Without this control, errors and fraud can hide in plain sight, because the same hands that move the goods would also be writing the records. Every phase leaves a paper trail, and those documents are how cost actually travels through the cycle. Phase A produces the purchase requisition, the purchase order, the goods receipt note, and the landed cost worksheet. Phase B produces the standard cost card and the predetermined overhead rate calculation, the POR. Phase C carries job cost sheets and material requisition notes. Phase D produces the variance reports, and phases E and F deliver count sheets, the LCNRV worksheet, the cost of goods sold entry, and the financial statement note. In practice, this means a document is rarely just paperwork. It's the trigger and the evidence for the accounting that follows. Let's pull the map together. The cycle is 6 phases and 27 stages, moving inventory from procurement through cost of goods sold as one connected flow, with cost accounting running through every phase, not just the end. Each department owns a clear slice of the work, and segregation of those duties is what keeps the numbers honest. The documents you saw are the rails that carry cost forward and the evidence behind every entry. Keep this framework handy, because each phase now becomes its own section. Next up is Phase A, where we follow how inventory first enters the business and is valued at landed cost. Thank you for completing this section on the inventory and cost accounting cycle overview.